Have you ever made a poor choice? Perhaps a poor financial one? Today, we're going to talk about some of the mental frameworks that lead us to make good or bad decisions based on how the brain processes information. So by priming your mind around the principles I'm about to teach you, you can become a better processor of information, starting with how you process private investments or startup opportunities. See, what I've found is by fixing these mental frameworks, this can give you the edge you need in your pursuit of making billions. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have a special edition podcast. Today we're going to talk about the mental frameworks that lead to bad investment decisions. These are all from my experience and research. Now, while this isn't financial advice, it is meant to give you a guide just so that you can catch yourself on how to process information in the right ways. So I boiled it down to really 23 cognitive biases of poor investment decisions. And for the next 23 principles, I want you to pay attention on how this affects some of your investment decisions, startup decisions, whether you enter, exit, even stuff in your personal life. All of these things can have an impact because it relates to your brain on how it processes information, particularly through the cognitive biases that we possess. So let's get into it. The first cognitive bias that we have, I like to call, is the anchoring bias. You see, under the anchoring bias, the mind tends to become over-reliant on information or impressions that it first receives. So this bias poses a threat to the investments as overly optimistic assessments that can create a good first impression and lead decision makers, including yourself, to lean toward the idea of the original plan or impression. This anchor can create, we'll say, inflexibility to pivot on plans or investments when they're required to do so. Next, number 2, availability heuristic. See, the mind tends to overestimate the value of information that is immediately available. This creates an impression that is known as the information comes in, that it tells you, or at least you believe that it tells you the whole story. Like, I personally know a guy that made the same investment and it worked out for him. So remember, you don't know what you don't know. The third cognitive bias we call is the bandwagon effect. The power of an idea or estimate to become accepted as fact becomes further ingrained as more and more people accept it as such. This is essentially what we call groupthink, and can happen as one question and or say changes come from people changing their opinion. People will do this just to fit into the group and believe that even though they know what they know, the fact that other people seem to agree on other aspects, we actually tend to change our information, start believing things that may not be factual just because other people believe them. Number 4, blind spot bias. Not recognizing that you have biases is a bias in itself. See, it's easier to notice the errors of another, but really hard to see them in yourself. Make sure that you check and say, you know what, I may have a bias on certain areas that I don't even know about. If you start to believe that you're not biased in any way, and when I say bias, I just mean you don't filter or unfilter certain information that is helpful or unhelpful. If you believe that doesn't happen, trust me, my friend, you're biased. Number 5, choice supportive bias. See, people tend to be more supportive of investments that they've made or will soon make. See, this bias also leaves people to further discount investments that they've rejected in the past. Remember, it's helpful in this scenario that past performance does not guarantee future performance. So make sure you're aware of this particular cognitive bias. Number 6, clustering illusion bias. See, the mind, it's wired to look for patterns. And this can lead to concluding that random events are somehow not random. See, if I said that differently, just the mind tries to connect the dots, so to speak. And even when there is no connection there, we tend to see patterns that don't exist. So expecting, say, random events to produce predictable outcomes, it's just going to lead you to making unfavorable investment decisions in this sector. So make sure that you watch for ways and ensure that patterns that you think you see are actually there. 7, confirmation bias. See, individual experiences and backgrounds create a diverse set of beliefs within investment committee. See, this can make for a healthier review of investments within the group, but It can also lead people to make errors in investing due to the tendency to value information that only confirms your preconception of a particular subject. So you got to be careful of this. See, this can lead to improper investing or processing of information. And improper investing is not investing, it's gambling. So please be careful of this cognitive bias when making decisions. Number 8, conservatism bias. If anchoring leads to the mind to lock onto the first idea, then conservatism leads the mind to resist deviations from those anchored ideas. See, the mind tends to value the first information received more than each subsequent update. This is kind of cool. See, this bias can lead investors to be resistant to changes even when changes would be beneficial for themselves or their investors. See, this can be seen during rapidly changing conditions. As both frequency and magnitude of required changes increase, the perceived value of the original information or the investment will also increase. See, the result here can lead to slow adaptability for both rapidly changing conditions and for innovation. Any of those are not good and can lead to poor decisions, whether it's investment or in your personal life. 9, information bias. See, the tendency to seek more information without impacting execution can lead to poor timing, which, depending on the investment, can lead to a poor investment outcome. Sometimes this is referred to as analysis paralysis. Be careful of that. Know when it's time to execute. And once you have enough information, only you can figure that out. But once you are, make sure that you turn that information into action. 10, the ostrich effect. See, deciding to ignore controversial or threatening, dangerous, negative information by burying one's head in this proverbial sand is like the ostrich. See, research shows that investors check in on their investments much less often during bad markets. So don't back away from turbulent conditions or information. Make sure that you always have both hands on the wheel, so to speak, and you're constantly monitoring changes in your investment and the information that leads to it. 11, outcome bias. The decision to judge an investment based on the outcome without an assessment on how that decision was reached can lead to some errors in your judgment. So for example, let's say investing on the outcome that you hope for or just simply want. Simply expecting an outcome doesn't change the probability of successful execution, even if it feels like it might. So proper, consistent, effective assessment criteria helps to reduce the effects of this bias as it relates to potential investment decisions. 12, overconfidence. See, it's natural to have the tendency to overestimate one's ability. Those that are confident can sell their investment ideas much better, in part because when the mind can perceive confidence, it minimizes the perception of downside risks. Overconfidence biases can lead investors to take on greater or even unnecessary risks with their capital. So I want you to make sure that you are cautious of the loudest voice in the room. 13, the placebo effect. Simply believing something will have an expected outcome can sometimes actually lead to that outcome manifesting. This can be seen when investing in projects that are primarily intangible, like productivity. See, it's difficult to measure in that scenario, and believing that there are benefits that maybe aren't actually there can sometimes even create that outcome that's desired, such as productivity. So believing a report make one more productive, but not because that report changed anything, but because one believed that it did. So capital was spent to change a report and benefit from productivity, but in reality, it was the consumer or maybe the employee's mindset that needed to change, not necessarily some internal report on productivity. 14, pro-innovation bias. Us as venture capitalists, we fall into this very, very often. And so catching yourself on this particular bias is a big one if you're in VC or entrepreneurship. See, innovation is really a great idea, but investing in innovation just because you perceive it as innovative can possibly lead you to a poor investment decision. See, this manifests in unproven technology where the usefulness may be overvalued and limitations are undervalued. Remember the dot-com bubble? Be confident that investing as an early adopter is an acceptable risk. 15, recency bias. The tendency to believe that the most recent condition will continue indefinitely can definitely lead someone to make a poor investment decision. Recent price swings, say in oil, is proof that maybe $100 oil doesn't last forever. Therefore, decisions driven by that bias can lead to poor investment outcomes. Again, sometimes the party's over. You got to know when to pull the cord and call it, and it's time to leave. 16, salience bias. See, the mind tends to focus on prominent attributes to draw conclusions. This is where irrational behavior in markets tend to manifest. Overbuying, overselling based on what one perceives as obvious or prominent can lead to a poor investment decision. So, for example, in 1632, Galileo challenged the salient belief that the Earth was the center of the universe. See, Galileo courageously criticized the obvious to unlock tremendous value in our understanding of the universe. So what this means is scrutinize the obvious. 17, selective perception. See, the mind tends to develop a reality that aligns to its perceptions or its expectations. So for example, believing that real estate is a great investment because a family member's a realtor and that's all you've heard for your entire life, well, that can lead to perceiving other opportunities as less value or not perceiving other opportunities at all. So based on your current training or conditioning of your mind may make you filter out other opportunities that could be good and you just can't see them because you've been so siloed in your belief and research. That's not bad, but just be aware of this particular bias. 18, stereotyping bias. See, quickly concluding that a person, a group, an investment class will have certain qualities before actually researching the fact can possibly lead to making poor investment decisions about those people, groups, or investments. Make sure you check yourself on this bias. 19, survivor bias. See, errors in the decision-making process can occur when only assessing investments that made it. Performance of investments and investment portfolios can overestimate performance by only assessing the projects that were completed. But what happened to those that were canceled or deferred or just fell completely off the rails? See, these investments didn't survive, but did impact the investment performance and should be included in performance assessments when trying to analyze information and make decisions. 20, zero risk bias. See, the mind likes predictability. So the tendency to eliminate all risk, even if it's counterproductive, is a bias that can lead to overinvestment of capital into risk mitigation. See, mitigation and elimination are not always the same thing. So be clear on what is an acceptable downside risk that doesn't stifle your process. 21, sunflower management bias. See, the inclination of people in organizations to align themselves with their leaders' real or assumed viewpoint can be a bias in itself. So for example, if you're making a decision or you're doing your due diligence or you're just running a company, let's use that scenario. So a CEO thinks that a particular acquisition, whether that's a fund or a company, is a good idea. So the managers and the analysts produce an investment assessment report that actually tells the CEO or the investor just what they want to hear. So make sure you check yourself on this bias to process proper information and make sure that you're not getting fed just a bunch of reports or research reports from a bunch of yes men and women. Tell me if you think I'm making a decision. 22, champion bias. See, the tendency to place too much weight on a person's reputation can turn them into the champion. You're focusing more on the opinions of the champion and less on factual information. See, this can lead to increasing exposure to risk just because you trust somebody who's an expert. That's okay to trust people, but always verify and make sure that you follow the trend lines more than you follow the headlines. And finally, 23, I call it the pendulation bias. The mind tends to form opinions of certain people, investments, or situations after a significant painful history, such as losing a lot of money. See, pendulation is a behavior that is led by the belief that a positive outcome will occur as long as I or somebody does the complete opposite of the last negative outcome. Also a reason why second marriages tend not to work out as high as first. See, accepting an investment simply because it's just the opposite of the bad last one can lead you to another unfavorable investment outcome. So make sure that you check your investment outcomes, make sure you study the facts, and also just check yourself on your biases, which is really just a way to say, is my brain, myself, my mind, my process, is it processing the information that's necessary so that I can make the proper investments that I need to do right by myself and my investors. So as you can see, how you handle your own cognitive biases, as well as those of others, can have a profound impact on how you make decisions, be it in your career, your personal life, or even your investments. So improving on how you process your information around your biases can support you in your pursuit of making billions.